If you looked at this thumbnail and knew the stock was the Score, then congratulations, because you are probably a Score shareholder. Now, most of you guys who are watching this video probably don't know what this company is, but the stock did pop 65% on the announcement of an acquisition, and at the end of this week, it ended off at 84% gain. So we'll be going over the story that happened this week, which is one of the biggest mergers and acquisitions in Canada. And at the end of this video, because this is a Monday video, I'll be talking about my TFSA portfolio, what happened in the past 2 weeks, and stocks that I bought with $400, as well as my market outlook for next week. And if you aren't invested yet and want to get started today, check out my link down below. You can get $25 for signing up for Wealthsimple Trade. And if you also get Wealthsimple Cash through my other link, you can get an additional $25. So that's $50 completely for free, no real cash there. I explained in my previous video how Wealthsimple is able to give away so much money. So if you're interested in that, you can check it out after this one. All right, no more playing around. Let's get started. So this past Thursday, Penn National, a US company, made the announcement that they're buying Score Media for $2 billion in a cash and stock deal. Immediately on this announcement, shares of the Score shot up by 65%. And by the end of this week, shares were up 84% from Wednesday's closing. Now this 84% gain might seem quite bananas. However, if we go back in time looking at the past year of the Score, we can see the Score was trading at higher than $40. It was even in the $50 range. So for buyers who decide to buy in that euphoria there, they're still down on their initial position. However, we can see all stocks in sports betting have come down from that reality when they all peaked earlier this year. But Penn National putting a dollar figure to what they're willing to pay for the Score is why this stock decided to shoot up, and Penn National didn't see that much of an increase in its own stock price. But a short-term gain in the stock price of the Score may not be what investors hope for, because some investors who bought into the Score were probably hoping to hold for 5 to 10 years and expect the company to grow way beyond a $2 billion company. However, now as a Score shareholder, you will be getting some Penn National shares, so you can still continue to follow along the journey of the Score and how they make impacts in the Canadian sports betting market. Now turning over to some statistics about sports betting. In October 2020, US sports betting hit $3 billion. And for reference, one of the largest sports betting companies in US, DraftKings, is only worth $20 billion. And in December 2020, New Jersey alone reached $1 billion in sports betting. And in US, only about 25 states have legalized sports betting. In 2018, it was completely banned, but in the matter of about 3 years, 25 states, or half the states, have legalized it. So you should see going forwards, sports betting will probably continue to be legalized by more and more states, as well as here in Canada, the restrictions will continue to open up. A research report said that in US 2019, the sports betting market was about $25 billion. However, in 2026, they predicted to grow to about $59 billion. There are also a couple of estimates made in 2018 where one organization believed that the sports betting market, if it was completely legal, would have been $55 billion. And another organization, their estimates were even loftier at $150 billion. And again, if you reference that to DraftKings at a $20 billion market cap, the sports betting industry is massive. And there's no clear winner yet, like Amazon is of e-commerce and Google is of search. And this is what ultimately is making sports betting so lucrative for investors right now, where people are gambling on the future and which platform is going to become the major player. There probably won't be a single player that takes all, but there's probably going to be 2 or 3 organizations that are going to be the big boys. And then maybe there's going to be a bunch of smaller ones that service different niches of sports betting. Now, if we look at sports betting and their share of the online gambling market, including lottery tickets online, poker, bingo, and stuff like that, then sports betting makes up about 40.3% of all of online betting. And if I were to bet, sports betting will continue to increase market share in online betting. Because if we look at the age demographics of sports betting right now, 50% of the users are between 18 and 34, and the median user's age is 38. If we compare that to the lottery, we're probably talking somewhere around 40 to 45 or even 50. OLG even stated themselves they're having trouble getting millennials or younger people to buy lottery tickets. So going forward, as people age and millennials get richer and richer, sports betting is only going to grow even more and more. And the lottery industry is probably going to go down further, and no one really plays bingo anymore. Now, if you're an investor in sports betting, you must understand why the sports betting industry will continue to go up if you keep leaving your money in there. And here are some reasons why I believe the sports betting industry has some good trends going for it. The first reason is that millennials and younger people were raised on social media. And the way that sports betting companies are targeting the millennials right now is adding a social aspect to sports betting, where you can bet against your friends on the app and have conversations and competitions. So this adds more fun to the aspect of sports betting. Whereas if you buy a lottery ticket or play a bingo game, there's no forums or places to chat about this. So there's little to no social aspect to buying a lottery ticket. And when you add the social aspect to sports betting, it's not only entertainment anymore when you watch sports, you also feel like you have a stake in the game. And because if you place a bet on a team and that team wins, then maybe you feel like you played a part in helping them win, as well as you earned a little bit of side cash. With sports betting, there's also a bit of mystery when you're entering into that activity, because you don't know if you'll win or lose. Ultimately, sports games, yes, the stats could be stacked up in your favor, however, the underdog team sometimes does prevail. So because there's a bit of mystery behind here, and you could potentially win a jackpot if you bet on the underdog team, this brings more allure to sports betting, just like people investing in stocks that are talked about on Wall Street Bets. The last reason I have why people enjoy sports betting so much is because every time that you make a correct prediction, you believe that you'll be able to make the next prediction correctly as well. And when you make a prediction correctly, you'll also be bragging to your friends, your family, your girlfriend, your wife about how you were right. And ultimately, by being right, you also get a sense of importance, or it fuels your ego or pride. And if we look at the stats between the genders of men and women, we can see that mostly it's men who are placing bets on sports, because men have a bit of an ego issue. Alright, now let's jump over to my computer and talk about what happened in my TFSA portfolio in this past week. Okay, this is crazy. If you've been following my journey for the past 19 weeks, you'll know that my portfolio has never been up by more than 1% or so. But today we're sitting at a gain of 4.55% on week 21. However, we're still down against the TSX index by about 1.77. As usual, I'm not too worried about that because 21 weeks is just under half a year. This portfolio is a 3-year portfolio at least, hopefully 5 to 10 years if possible. Going over some of the percentages here, we can see that 56.4% of my investments pay dividends versus the other half do not. And in terms of the risk level, I only have 22% in high risk stocks, 39% in low risk, and 37% in medium risks. So this is a relatively well-balanced portfolio in my view. I currently hold 16 positions in this portfolio and only 4 positions are in the red right now. 2 of these being high risk stocks, Well Health and GDMP, and 2 of them being medium risk stocks, Eng House as well as Air Canada. If we sort this portfolio by 1 week performance, we can see the Bitcoin ETF has finally started to take off. It's up 13% and I'm finally up on this position. If you remember a couple weeks ago, I used to be down on this position anywhere from 30 to 40%. And that kind of drop to most investors is scary. However, me going into Bitcoin, I knew that the risks were there and I would be down. However, I do have faith that I will be up in the long run, whether it's in this next year or 4 years from now. If we hop over to the transactions in the past 2 weeks, we can see that I received 3 dividends. The first one from Power Corp Canada, a juicy dividend of $5.82. Then one from TD of $2.37, and the last one is a measly 30 cents from Dollarama. At least they pay a dividend though. In terms of what I bought, not too much happened the past 2 weeks, but I bought 3 shares of Air Canada, 5 shares of Well Health, 1 share of TD, 3 shares of Algonquin Power Corp, as well as another 2 shares of Air Canada. And you might be asking why I'm buying so much Air Canada. And right now, Air Canada is a position I'm still down on by about 3%, and the rest of the positions are up by a fair amount. So I decided to increase my position in Air Canada as it's below my cost basis. And the rest of the stocks, I couldn't really justify putting in money just right now because I felt like this week or the past 2 weeks were a little bit euphoric and we might see lower prices going forwards in the future. If you haven't realized a trend in how I'm buying stocks, they tend to be the stocks that are down in my portfolio or have a marginal gain. The companies that have gone up quite a bit, I tend not to buy into their stock just because I feel like the overall market is relatively expensive if we compare it to the past 10 to 20 years. And eventually that euphoria might come crashing down, or the other alternative is the market will stay flat for a longer period of time. Because I don't believe the market can continue to go up in a way without no ends. There has to be some way for these businesses to catch up in their valuations so they make sense, and that's when I'll be buying those more expensive businesses, or we have to see these businesses come back down to reality so that they're a bit more fair valued. For many of you who are watching this video, you're probably falling into the category of invested in the market for only 1 year. But you have to remember, investing is a long-term game. This is going to be a 20, 30, or even 40-year game for me, probably 50 or 60 to be real, if I'm still alive then. So seeing major returns in a couple of months is a great feeling. However, I must do a reality check and always realize that there could be danger coming around the corner. In terms of what companies I'm looking at next week, Shopify is a company that's been on my radar for a while for this portfolio. Again, Shopify is always very expensive. They have a P ratio of 79. However, I do believe this company in the future will be worth more than $1,900 per share. If you look at their 1-year chart, they recently went on a little bit of a tear, rising about 28%, but I do believe there's opportunities to catch some dips. So my current price target for buying or trickling into the Shopify position in this portfolio is around $18.50. Again, I'm dollar cost averaging in, so yes, Shopify could have a drop like we saw over here where it dropped 26%, and there I'll be ready to catch more shares. Now, sorting my portfolio by current market value, I'll probably be looking to increase some of the underweighted stocks in my portfolio. I'm always looking for new entry points into DCM, but right now at $1.38 is roughly my cost per share, so I'm waiting for this stock to drop to about $1.30 before adding more to this position. I'll also be looking to add more Ryokan and probably Telus if the prices are right, and Dollarama if they do come down. Dollarama does have some swings here and there, but right now at $59, I'm probably going to hold off for a little bit. If we see some downturn in these three companies, TD, Algonquin Power Corp, as well as Sun Life, I will also be looking to pick up shares of these companies. Right now, you can see my cash position still sits at about $116, so I didn't invest all $400. That's just because I didn't find that much value in the market this week, so I decided to keep some more cash on the sidelines. Thanks again for joining me on this Monday episode. I'm going to be throwing up 2 videos on the screen. If you're interested, you can check them out. If not, keep up the grind and have a great day.